Welcome back. I'm Jesse Baines with Yahoo Finance Canada. On today's episode of Editor's Edition, we're talking real estate during COVID-19. And things have changed since we last talked. The federal government's made its move to cool these hot housing markets. And the Bank of Canada, well, it's changed its tune a little bit when it comes to interest rates. Here to help make sense of it all, from Toronto, we have Realosophy Realty's John Pasalis. Hey, John, thanks for being here.
Thanks for having me.
And from Vancouver, we have Oakwind Realty's Steve Saretsky. Thanks for being here, Steve.
Yeah, looking forward to it.
Okay, let's start with a bit of a wide angle lens on the national housing market. The latest numbers from CREA. The numbers are going to be a little bit ridiculous because the jumps are huge. Obviously, last March, things were different. The lockdowns were just starting. The economy was frozen. Nobody had any idea what was going to happen. But sales are up 76.2% compared to last year. The home price index up 20%. The average sale price up more than 31%. Average price $716,828. Just for fun, I throw that out there. But John, let's start with the Toronto number specifically. What does the picture look like since we last talked?
So Toronto hasn't changed too much. I mean, we're still seeing really, really strong growth in low-rise house prices. They're probably up over around 30% right now over last year. And what we're starting to see is a pickup in the condo market. So it's not really driving the price growth, but at least prices are trending up year over year, like in the single digits. And that's the market that is starting to become quite a bit more competitive right now.
Is there a divide between the downtown condo market in the core versus the suburbs, or is there a bit of a catch-up going on yet when it comes to downtown?
Yeah, so there was for a while. I mean, up until around December, it was really just the suburbs that was busy. Downtown was slow, but right now I'd say it's kind of across the GTA. Is pretty competitive. Supply's just been kind of gobbled up basically, and there's not a lot of inventory. I mean, it's under a month of inventory for condominiums, under a month of inventory for houses. So still a really tight market, but on the ground, we're starting to see it's becoming a little less competitive, fewer offers on offer nights, some homes with no offers on offer nights. So it's still a seller's market, but it's not quite as crazy as it was even 3-4 weeks ago.
Okay, how about in Vancouver, Steve, starting with the low-rise market?
Yeah, I mean, obviously that's been the leading strength segment of the market, right? I mean, you've got houses out in the suburbs, still up 30%, inner city at 20-25%. So really strong price growth, single family townhouse market. And then it's been the condo market, similar to what John said in Toronto. The condo market here in Greater Vancouver has been on a lag. I mean, I think that it's only now that we're starting to see some strength there. Condo months of inventory is now below 2. For a good 6 or 7 months there, it was hovering around 4.5 months of supply. So we've seen a lot more demand in the condo segment. I think overall, again, this seems to be mirroring Toronto very, very closely. But what's always interesting is I find that it's the anecdotes that you kind of have to pay attention to. And what we're seeing anecdotally over the last couple of weeks is similar to what John's saying in Toronto. It's just a slowdown. Everybody's just saying, okay, well, hold on, we're going from 7 offers on a house down to 3, down to 2, and so everyone, fewer showings. So it's very interesting. It's much too early to call it, a big change or a trend shift in the market, but it's something I'm personally paying attention to, and we'll have to wait and see how this plays out here moving forward.
So, John, in the Greater Toronto area, does that mean price growth is starting to steady a bit and level off in the coming months?
Yeah, I mean, I'd say, okay, so in the coming months, we're still going to see like this crazy 30+% price growth because we're comparing to last year, right? But in terms of month over month, yeah, for a while, we were seeing just rapid price growth from December to January to February, and that's easing up now because there's fewer offers, buyers are less anxious. And I think it's worth noting that it's a really interesting trend because I think the assumption when OSFI, our bank regulator, kind of announced the stress test change, which we're going to talk about, was the idea that buyers are going to rush into the market right now, and the market would be even more heated than it was. So to me, it's really kind of interesting that we have this potential policy change coming up, and the market is still just naturally slowing down.
So a natural slowdown. So are you saying that maybe governments didn't need, and we're going to get into the policy stuff, but sometimes it's best for governments just to sit back and let the chips fall and everything will be fine? John.
Yeah, I mean, 100%. I mean, I do think to some extent it was smart for the federal government not to jump in and try to, kill demand, so to speak, because when demand's driven by home buyers, the way to kill it is just to make it harder for a home buyer to buy a home, which I don't think is a good idea and certainly wouldn't be politically popular. And the demand's just going to run its course. And I think that's what we're starting to see on the ground now, that it's just gradually unwinding.
Steve, in Vancouver, do you expect that prices will level off a bit? I don't expect home ownership to be easy in Vancouver anytime soon, but do we see a flattening a bit?
I mean, that's, personally how I've been advising like my own clients. I mean, if you look at it, Greater Vancouver single family house prices from February to March, I mean, there's a 5% increase in the home price index. So, okay, so if you say, okay, well, 5% in 1 month, I mean, you start extrapolating that 60% a year. I mean, I'm sorry, if anybody expects that house prices are going to go up 60% a year, it's just not going to happen. And so, we've seen now, like I said at the beginning of the show, 30% price growth year over year, basically in a lot of these segments of the market. And I think anytime you get that sort of excessive acceleration in home prices, it's due for a pullback. And so personally, like how I'm advising my clients is like, listen, if you're going to buy a house today, I don't think it's unreasonable or unrealistic to make the assumption or the expectation that there could be a very decent probability that in 12 months from now, that house could be worth 5 to 10% less than what you paid. You bought, if you're buying at a time when house prices just ran up 30% in 12 months, like I think it's almost healthy to have somewhat of a healthy pullback or correction. So I don't know if I'd say that's imminent, but I think there's a pretty decent probability of that for sure.
Right. So still with Steve, we talked about the bidding wars sort of calming down a little bit and not quite as competitive. So is now a better time to get into the market than it was a couple of months ago for the end user or the first time buyer especially?
Yeah, I would say it's definitely easier. Like I said, it's less competitive. I mean, it's still a competitive seller's market. I mean, you should still be expecting to compete. You're still not really getting a discount on the price. You're still paying full valuation, but again, you're not competing with 8 people. I mean, I would say that probably February marked the top of the market here. I mean, just the amount of the crazy offers that were coming in way above ask, where valuations made no sense, is usually a sign that things are getting pretty frothy. And I think, we look in hindsight here now towards the end of April, certainly slowing down in the last couple of weeks. Maybe that was the highs.
And does it get plane flying above us somewhere? Does it get easier in the summer months? Summer is typically a busy time of year, but as we've learned throughout the pandemic, seasons haven't mattered too much. Do you expect the bidding wars and the competition to heat up again come summer?
I mean, I don't think so. I think this momentum will probably gradually cool down. Summer's usually a little bit slower. And I think with more inventory coming up, fewer buyers in the market, we're probably not going to see a ton of buyers start looking for homes in June after the stress test starts. So if we see any change, it might be in the fall, like in the September, October months. But I suspect that things are probably going to, probably stay a little bit more balanced towards the end of the year.
All right, so we'll be watching for that. Meanwhile, let's shift gears a little bit to some of these policy changes we hinted at off the top, starting with the first federal budget in 2 years. Finance Minister Chrystia Freeland announces a non-resident tax on homes. Have a listen.
Houses should not be passive investment vehicles for offshore money. They should be homes for Canadian families. So, on January 1st, 2022, our government will introduce Canada's first national tax on vacant property owned by non-resident, non-Canadians.
So, John, is a 1% vacancy tax on non-residents the right move right now?
I mean, I think it depends on your goal. I mean, if you want to make it look like you're doing something without really doing anything, then I think it is, because I don't think it's going to do very much. And I say that largely because like the percentage of properties owned by, what we call pure non-residents is relatively small, and the percentage of those that are sitting empty is probably even smaller. So certainly it might have a little bit of impact, but I don't think it's going to have like any huge impact on the housing market.
Okay, so in Vancouver, Steve, I should mention Toronto already has its own 15% foreign buyers tax. Vancouver raised theirs to, was it 20 or 18, Steve?
Yeah, we went from 15 to 20.
Right. So when that happened, I remember we talked about it. Vancouver Mayor Kennedy Stewart said that did a lot to bring supply onto the market. Do you think 1% isn't? I mean, we still have to work out how this is going to work when you have provinces with their own or regions with their own tax already in place. How are you going to divide that up? How's that going to work? But slapping another 1% onto what you already have there, do you expect that's going to make any kind of real difference in Vancouver when it comes to supply?
I mean, I just look at it from like Vancouver's perspective, and I think you could certainly argue that it had some impact. I mean, as a 20% tax, but like when you start to look at it, like again, like the market was cooling prior to the foreign buyers tax came in, and I think it was a policy shock that when the tax was announced, like obviously the housing activity froze, and then but like if we fast forward to where we are today, we've got a 20% foreign buyers tax, we've got a BC government speculation tax on underutilized homes. We've got an empty homes tax in the city of Vancouver. So we've got 3 taxes from 3 different levels of government, basically. And, if you look at it today, I mean, I would argue that Vancouver is not any more affordable. I just don't think it's really, it just hasn't necessarily done what I guess it was, expected to do. So do I think a 1% national tax is going to be effective at bringing affordability? I just don't see it. I mean, if you even look, I think the problem is the way even the government like looks at foreign ownership. I mean, if you look at CMHC's report back in 2019, where they started tracking foreign ownership, I think they said in Vancouver it's only 7% of the market, and in Toronto it was 3.8 or something like that. So, by that measure, you're saying, okay, 3.8% of foreign owners are going to have to pay a 1% tax. But then on the flip side, what's a 1% tax? It's almost like the cost of doing business. So if you're going to say, well, hey, if home prices, I think over the last decade have averaged nationally, they've gone up on average 8% per year. So 1% is just like the cost of doing business. So I just don't think it's going to be very effective. I think it's it's a political lip service, right? I mean, it looks like they're doing something. It's easy to sell politically. But in terms of its effectiveness, I just don't see it being very effective.
Yeah, I mean, 1%, I should point out, is less than most mutual fund fees in this country. So I don't know if it's going to make a big difference to deep-pocketed buyers. But before I get your take on that supply question, John, let's have a listen to, Bank Canada Governor Tiff Macklem said that he seemed quite happy with the stress test that we talked about. We'll talk about a little bit more as well, and that foreign buyers tax, if you will. Have a listen to what he said a couple of weeks ago.
If you go back to 2016, 2017, one of the things we saw is that particularly in Vancouver and Toronto, there was some evidence that foreign purchases of homes were contributing to the large price increases we saw. And there's certainly some evidence that those homes were being purchased not to live in, they're being purchased as investments, and they're vacant. And the problem with that is that when you purchase a home and you leave it vacant, you're taking housing stock effectively out of the market. Nobody can live in it. A tax on vacant homes, what it'll do is, first of all, it'll probably dampen enthusiasm for speculative buying of homes, but to the extent that those homes are purchased, it'll encourage the owners to rent them out. So people are living in those homes, and they are contributing to the housing stock. They are contributing to the supply of housing, and what we're seeing in the market is that demand is running ahead of supply. a big part of the solution is to get supply to catch up with demand.
Okay, so John, I know you like to study the bigger picture as well, what's going on with the rest of the markets outside of the GTA, but in the GTA and even outside of the GTA, do you expect this to have any meaningful impact on supply coming to the market?
Yeah, again, I don't think it's going to have a big impact. Like Steve said, very small percentage of homes owned by non-residents. And of them, you got to imagine it's even smaller percentage that are sitting empty. And even if they are, I agree with Steve. I mean, even in the GTA, the rate of growth in house prices has been higher than 8%. I mean, so if we say it's 9-10%, you got to pay a 1% annual fee. I don't think it's a big deal. I think there's other things that they could or should have done, but this is not going to do anything to help affordability.
Okay, so the other takeaway, the other big event there was that, we've talked about this on just about every show, is this language where the Bank of Canada has said from the beginning, we're going to keep rates low until 2023, until our inflation target is met. As Steve said, we've got your back, is what they've said. If you've got any major purchases that you plan to make them, and don't worry about it. But this time something changed. They kept their overnight rate, the Bank of Canada did. But there was a tapering of the quantitative easing program, and they said that they now see inflation hitting its target in 2022 rather than 2023. So starting with Steve, what does that do to psychology when it comes to buyers as well as sellers?
I mean, I think it's going to change the psychology, and I think maybe that's what the Bank of Canada perhaps intended to do. I mean, my personal view is I still don't think that, just everyone's saying, well, they're going to hike interest rates now in 2022. I mean, I don't necessarily agree that's the takeaway. I think that what they're doing is they're leaving it open for interpretation, and they're leaving that optionality on the table. So I think certainly leaving that optionality on the table will start to make people think twice, right? I mean, hey, do I go variable rate? Do I go fixed rate? Like, how much leverage should I be taking on? Is the Bank of Canada's inflation really starting to take hold and they're going to start having to hike rates? I think it starts to make people think twice, at least, some of the more savvy investors anyways, that are paying attention to this stuff. So I think at least from a psychological perspective, it definitely matters.
Mm-hmm. John, what's your take on the psychology when it comes to that? I don't want to say forward guidance, but again, like as Steve says, leaving the door open for a 2022 hike rather than 2023.
Yeah, I mean, I agree 100%. It's really about the psychology. It is forward guidance. It's about the psychology of the market. And I think most people, including myself, I mean, when I think most of the criticism of the Bank of Canada's policies has been this, overly aggressive tone about keeping rates low for a very long time. And I think it did help fuel, I don't know if it wasn't necessarily speculation, but the anxiety from home buyers to rush and buy homes now. And I do think that sort of this tone that rates will likely be increasing or rising sooner rather than later. I mean, whether they do or not is almost irrelevant at this point. The point is more that they've kind of set they changed the narrative that it might happen. So I definitely think that it does shift the mindset of investors tomorrow and of home buyers as well, certainly.
So John, I mean, in your view, what are we talking about here? Are they going to move in 25 basis point increments, or as they did in the past, as when Stephen Poloz was governor and we had the oil price shock, it was quarter point increments. I believe there might have been a 50 basis point hike in there somewhere, but it was gradual, right? So I mean, do we expect to see something similar this time around, John, where it's a gradual increase or a sudden ramp up that could create some sort of shock?
I mean, I don't even necessarily think they're going to necessarily increase rates next year. I mean, I think if we see a rise in inflation, I think at that time they'd have to see, is this short term or is this going to stay with us for a while? And if it is short term, then they're probably not going to increase rates. So, I think it's tough to say what they're going to do, but I think the bigger point is that it kind of doesn't matter what they do a year from now, because the bigger issue is right now that they've at least kind of indicated to the markets that they may be raising rates, a year from now rather than 2 years from now, which I think is a huge difference.
Mm-hmm. Steve, what do you think would be the path to higher rates for the Bank of Canada? Small and steady gradual increases, or something different?
Yeah, so I think we were kind of joking about this pre-show, but my personal opinion is I think that there's so much debt in the world, and not just in Canada. Obviously, I mean, look at the federal budget. I mean, that budget is all predicated on keeping debt servicing costs, pinned to the floor. So I just don't think the Bank of Canada has any real ability to meaningfully raise interest rates, because I don't think there's any level of society that can actually tolerate meaningfully higher interest rates. So while you might have some inflation scares, as the Bank of Canada likes to call them, transitory, I think they're more likely to let inflation run hot and see how things sort of shape out. And certainly a little bit of inflation on a mountain of debt that we have might actually be a good thing. So at least to sort of erode some of that if they can keep their borrowing costs pinned to the floor. So again, I don't know, I think it leaves the conversation open for some form of yield curve control, which they've said before is in their quote unquote toolkit. But yeah, that's my personal view. I just don't think the Bank of Canada has a whole lot of legs to stand on.
Okay, the other thing Governor Tiff Macklem praised the federal government for, I mean, this isn't taken effect yet, but the new stress test rules for anybody with 20% or more, the minimum qualifying rate would go from 4.79 to 5.25%. Have a listen to what he had to say about that.
There is rising loan to income ratios. Sorry. So when you see people taking out bigger loans relative to their income, you worry that they may be overstretching. And as I said, in an environment where we've seen rapid price increases, there is a danger that people extrapolate those price increases. They expect that those will continue, and they overstretch on that basis. That's something that's worrying us. We are seeing some evidence of extrapolative expectations and speculative behavior. And as I said earlier, I think the proposal by OSFI to put a minimum qualifying rate in place will be helpful in that regard, because it'll protect, particularly in this low interest rate environment, it'll protect borrowers from overstretching.
Okay, starting with you, Steve. He says that it'll help protect buyers from overstretching. Do you agree? When we talked about debt loads, do you agree with his assessment?
I mean, I think that, the official numbers are it's going to reduce borrowing power on average by 4.5%. So I think with that capacity, yes. I mean, to be honest, I know that there are some banks out there that are counteracting the stress test in ways by basically increasing the total debt service ratios. I'm not at liberty to discuss those banks, but I mean, so I don't know. I think there's always... Yeah, geez. I know there's always some workarounds and stuff like that, but that's the, so I don't know. I don't think it's gonna have a meaningful impact. Like, I don't know. I look at the stress test that was brought in 2017. Obviously, it was significant at the time. It certainly had an impact on the market when it was introduced. And like, again, here we are looking forward, and national home prices are up 20% as measured by the home price index. So I still think like the way that you get a real housing correction is going to be through higher interest rates. But I don't know. So I think the stress test, I don't think it's going to do a whole lot personally.
Do you think it's like a bit of a case of been there, done that? Because we saw a stress test a couple of years ago, as you mentioned, and it took a bite out of house prices for a while. But do you think that, Steve, that the market's sort of gotten used to the effects of a stress test, and now maybe it's not such a big deal? I mean, it's not a whole new stress test, but it's a bumping up.
Yeah, I don't know. I mean, I think John might disagree with me here, but I think that, I don't know. Yeah, I just look at it and like, they're always like, you can go to the credit unions and they don't have to stress test, or, if you go to the big bank, you're a good customer. Okay, we might be able to get some leeway, some exceptions here and there. And like I said, some of them are offsetting their debt servicing ratios. So I don't know. I just look at it and say, we've got residential mortgage credit growth running at, decade highs right now. Maybe it'll slow it down a little bit. But I still think that the market, I just don't see this as like a game changer. Let's put it that way.
Okay, John, your turn to agree or disagree with Steve.
I mean, I agree in the sense that it's certainly not a game changer. I mean, it's a 50 basis point increase. Obviously, it's not gonna be the thing that sort of crashes the housing market. I mean, I think it's likely to kind of lead to more of this cooling down that we're seeing, like a more balanced markets towards the end of the year. I think it also is probably just an admission that maybe that the bank overstimulated our market. I think, if you listen to what the Bank of Canada governor is saying, they're worried that people are taking on way more debt. I mean, people taking on way more debt is directly a byproduct of pinning rates to the floor. I mean, you can actually borrow more, and they were encouraging people to borrow more. So now that they are, I mean, they're turning around and say, well, wait a second, maybe you're borrowing too much. Maybe I'm fine with increasing the stress test. So, I mean, the way I see this, I think it's basically the Bank of Canada saying, okay, maybe they kind of overstimulated our market a little bit, and we need to kind of start tapping the brakes a little bit, which is probably why they're behind it.
John, he told you to borrow.
They told us to borrow.
2023.
Get a mortgage. Buy a car.
So yeah, now it seems like we're trying to sort of rein in oops, maybe too much. So let's rein it in a little bit. And now I think we're going to see obviously this how this tapering goes.
Mm-hmm. Yeah, hope to get into the tapering more when we have a little bit more time in upcoming episodes. But I just want to point out that, John, I mean, we've had the opportunity to dissect the Bank of Canada's moves for I think our 11 episodes now, but its feelings weren't hurt. For a second time, it's the second time, I believe, right, that the Bank of Canada is using your research. Tell us about that.
Oh yeah, that's right. So I mean, we share data with different government organizations. I think the Bank of Canada released a note last month, just kind of using some of our data on the sort of the hot housing market, the share of property selling for over asking, the ratios of that. So yeah, we tend to share data on, I mean, those are kind of really high level stats, but also on like speculative activity and things like that. And, we're kind of happy to do that. I think if it informs, public policy decisions, I think that's great. But yeah, that's something we've been doing for some time.
Yeah, you be sure to check that out. And speaking of overstretched buyers, government policy, and having your back, let's take a listen to, this was a couple of weeks ago on TVO's The Agenda with Steve Paikin. For the record, we invited Adam Vaughan, Parliamentary Secretary for Housing, to join us today. He wasn't able to join us, but let's have a listen to a clip of him talking to Steve Paikin on The Agenda a couple of weeks ago. Have a listen.
If housing prices are going up 30 to 40%, and they're only going, I mean, the suggestion in that clip was they might go down 10%, that doesn't sound like the kind of volatility that ought to freak too many people out, don't you think?
Well, it's a situation where you don't want people to be underwater with their mortgages, and you don't want people who have made deposits on properties suddenly finding themselves underwater if they close the deal, because they'll start walking away from projects and that could collapse and have impacts on the development industry. So you've got to be very careful about this. I think the real issue here is not so much deflation or pushing sort of popping the bubble. It's we've got to sort of bring it back into ratio with the economy. And I think the trouble is that we've got global real estate markets in major cities, but we still have a Canadian economy that people are earning income from, and it's out of balance, quite frankly. And so we have to pull some of the speculation out of the market to try and dampen the inflation, and then we have to build those bridges to home ownership, in particular, as I said, first-time buyers. And it's a number of measures you have to take, but the risk always is whatever you do to make it easier to buy a home, you create more inflation. And so it's not as easy. It's not a binary sort of dynamic of just supply and demand. There are also some other monetary components to it that have to be examined and understood.
No, I hear what you're saying, but on the other hand, if the prices are going up 20, 30, and 40%, if it comes down 10%, that's not going to put anybody underwater. Fair to say?
In the short term, perhaps not, unless you're in a position where you've got to move and all of a sudden you're taking a loss on a house you just bought. That could wipe out or make difficult your next purchase. So you have to model these numbers into individual circumstances to understand the impact they have on different Canadians in different parts of the country. But I think the real issue is how do we get that inflationary sort of surge that's in the market right now back into an area that is a bit more normalized, and how do we turn home ownership into an opportunity without making it a risk?
Okay, starting with you, John. For the record, I know that Adam called you, and you guys have talked about this, despite your criticisms. But he seems to almost balk at the idea of a 10% correction. What message does this send to anybody who currently owns a home and maybe thinking about buying a home, John?
I mean, the message is obvious that the government's doing whatever they can to kind of keep house prices high. I mean, which is clearly why they didn't do anything in the federal budget to try to cool the market. I mean, the government's dependent on housing to pull us out of this recovery. Housing makes such a big percentage of our economy. I mean, and in Adam's defense, listen, I think his tone isn't right. I don't think what he's saying is correct. But the reason the government's worried about even a 10% decline is that, if house prices fall nationally, it has a ripple effect, and our entire economy is highly dependent on housing. So you could have, I mean, that in and of itself could lead to a worse recession. Now, again, I don't think it's right for policymakers to try to inflate house prices or try to keep them as high as possible. But this is the reason why they're worried about a decline in the future, because it could potentially have big ripple effects economically in Canada.
Okay, Steve, only a couple of seconds left. What's your take to close out?
Yeah, I mean, I think it's, I think housing is the Canadian economy. I mean, you can agree with it or disagree with it. I think that's basically what we do. We essentially export, housing. So yeah, I mean, I'm not surprised that they want to preserve the values. Obviously, I think the people that get the short end of the stick are the young buyers trying to get into the housing market, are unfortunately struggling to do so. So.
Yeah, and we heard Bank of Canada Governor Tiff Macklem saying that Canadians are writing to him and calling and saying, they are concerned about the current situation with the housing market struggling to get in. So we're going to have to leave it there. Thanks so much, John Pasalis of Realosophy Realty.
Thanks for having me.
And Steve Saretsky of Oakland Realty. Thanks for joining us, Steve.
Always a blast. Thanks for having me on.
And be sure to follow John and Steve. They share all kinds of interesting stats and perspectives on the markets. Give me a follow as well. If you have any questions for these guys, let me know. Meanwhile, be sure to check out Yahoo Finance for all your news on the real estate market. Check out your stocks, see what's going on with Bitcoin. Thanks so much. See you next time.